Hello, representatives from Canadian University. My name is Jessica, and here are my colleagues Antonia, Bridget, Carolyn, and Cassia from Finance for Life. We're here on behalf of SCD Asset Management to present a strategy to manage $1 billion of your endowment fund to transition your investment to a net zero greenhouse gas portfolio by 2032. In designing this portfolio, we note that the fund is expected to endure in perpetuity, must be oriented toward capital protection with a low risk tolerance, while still seeking moderate growth with a long-term horizon. We also provide a substantive net zero targets for 2025 and a total transition by 2032 as per the NZAO target setting protocol, as well as a strategy to measure them. Additionally, all of the investments proposed are instruments that are available to Canadian institutional investors. Even though shifting to net zero is an important target for many companies and investors, there's still ambiguity with what net zero actually means and how to achieve it. Under the 2015 Paris Agreement, countries agreed to cut greenhouse gas emissions to limit the increase in the global average temperature to well below 2 degrees Celsius above pre-industrial levels, and pursuing efforts to limit it to 1.5 degrees. As outlined in Net Zero Investment Framework, net zero investment strategy should focus on achieving two alignment objectives. One, decarbonizing investment portfolios in a way that is consistent with achieving global net zero greenhouse gas emissions by 2050, and increasing investments in the range of climate solutions needed to meet that goal. Our proposed strategy does this by investing in companies that have set clear, science-based targets at the portfolio and asset class levels so that we can effectively achieve portfolio alignment, meet targets, and enable a full transition to net zero by 2032. We analyzed Canadian University's current portfolio performance so that we can propose a greener portfolio that at the minimum matches the current portfolio's risk and return. I will now pass the following time to Carolyn to further discuss our strategy.
Thanks, Jessica. So as Jessica mentioned, my name is Caroline. We found that measuring the temperature increase is a better use of the data than looking at simply net zero, because net zero is a relatively new space. There's little data to accurately forecast risk and return. And further, there's not a recognized consensus on the measuring of net zero, of what it means to be net zero. All of the information that's provided is mostly self-reported, and it can be a limited process. Further, immediate divestment in high carbon risk organizations reduces the diversification potential for the portfolio, thereby increasing its volatility and decreasing its potential returns. Instead, as mentioned, we propose a portfolio that is aligned with the NZAO target setting protocol by focusing on the 1 degree increase. The Finance for Life team has created a specialized metric system to evaluate the current portfolio commitment to net zero status and goals based on past, current, and future greenhouse gas emissions, current levels compared to the 1 degree increase, risk levels, diversification, and the overall market distribution. We understand that your current portfolio is a 60-40 split. What we are proposing is to keep a portfolio that's similar in weighting, but we would have 60% stock, 35% in bonds, and then 5% on alternatives. Now I will pass it to Bridget, who will talk about the specifics.
Thank you, Carolyn. So in building the portfolio, as Carolyn mentioned, we kept the 60% stock that your portfolio currently has, as we believe this will continue to give you the moderate risk level that you're looking for, while allowing a provision for capital appreciation that you require. In choosing the composition of stock proportion going into the portfolio, we recognize that although net zero isn't new in concept, rating of companies and investments is still in its infancy, with only a few trusted systems available. We looked at various methodologies and settled on a rating system provided by Science Based Initiative as the best and most trusted option currently available. This methodology is recommended by the IIGCC and has most publicly available data at this time. A listing of certified companies is available that provides a level of their commitment and target dates with supporting information. As their rating system has been adopted by a variety of companies in diverse spread across industries around the world, we were able to pull from their listing of thousands of companies to build a diverse portfolio of companies available for trading. This listing of over 700 companies we invested in have committed to net zero, but have not all attained their goals yet. We will talk about how we scored these companies and further evaluate the portfolio shortly. In allocating the $600,000 of the $1 billion entrusted to this list of companies, we used a percentage allocation in line with the sector allocation percentages in the S&P 500. We know that at least 30% of the S&P 500 companies are certified under this science-based target system, and we expect more to come on board in time. In modeling this allocation in this way, we expect that earnings projection to be in line with market returns, which we have noted will meet your return goals. Now, in evaluating the level of net zero alignment of our stock choices, we recognize that there aren't a standard evaluation tool or metric for our portfolio of companies that had not yet attained net zero. As such, our team has devised a scoring system to rank companies through this transition so that we could track our portfolio level of commitment over time. As mentioned, we first used the science-based targets to identify a list of companies that have made a commitment to setting net zero targets by 2050. From that list, we then gave companies a score based on whether they had set targets consistent with a maximum temperature rise of 1.5 degrees, well below 2 degrees, or between 1.5 and 3 degrees. Additionally, we assigned a score based on the timing of these targets. The score was evaluated for companies who have set their targets for 2025, between 2026 and 2030, and between 2031 and 2050. Best score that a company can be assigned over these two criteria is 2, and the worst is 7. When we ran our selected stock portfolio previously discussed through this scoring system, it returned as 50% alignment with our net zero targets. This is in line with our 2025 goal. We plan to reevaluate this stock portfolio on an annual basis, adjust, and based on new additions and those coming into the market or dropping poor performers, we aim to reach a goal of 70% alignment by 2032. We expect to fall short of this 100% alignment as we aim to keep a diversified portfolio. The remaining deficit is proposed to be achieved through offsetting alternatives, investments that we will speak about shortly. I will now pass you back to Carolyn to speak about the bond portion of our portfolio.
Thanks, Bridget. Given the identified criteria that you provided, we recommend a 35% of your portfolio be invested in bonds. Bonds make up, this split is recommended to achieve your identified moderate risk tolerance. And we've opted for all coupon bonds to ensure that a level of guaranteed income. As part of this process, we used a 4-step approach in selecting the bonds that fit our established criteria. The first was an elimination of all funds that had exposure to high carbon, human rights, or regulatory risk. The second was maintaining a fossil fuel inclusion threshold of between 1% and 5%. The third was a clear strategy that covers and aligns with the bond principle or the green bond principles, which include the use of proceeds, clear communication for project selection and evaluation, management of proceeds, and reporting. Finally, we made sure that we selected bonds that supported companies and governments that have an active commitment to net zero between 2025 and 2050. We use Morningstar Sustainalytics rating system as a benchmark to measure our carbon exposure. And we found that a lot of funds are relatively new to the green bond space, and sufficient data for proper and complete assessment is very limited. We intend to continuously monitor the space and rebalance the portfolio annually. Now I'll pass it over to Cassia.
Thank you, Caroline. To further offset carbon in our current portfolio, we suggest a 5% investment in alternative strategies. Canadian University is in the business of developing the brain power that will shape the future. So what better way to attract the best and brightest minds than by bringing your commitment to net zero on campus in a visible way? Students now more than ever want to know how their university fits into the bigger picture. We think that by exploring alternative investments like construction of a microgrid on campus or participation in the Community Forest Carbon Offset Program, Canadian University will generate real savings and carbon offset credits. For example, the Illinois Institute of Technology was experiencing 3 or more power outages a year, costing roughly $500,000 annually in downtime and restorative costs. As an upgrade to its aging power infrastructure system, IIT implemented the Perfect Power System microgrid. It cost roughly $12 million to build and is estimated to save $5 million immediately in needed infrastructure upgrade costs and saving somewhere in the range of $500,000 to $1.5 million annually through demand response shaving, consumption efficiency, and grid services. Further, the microgrid has proven to be significantly more reliable with lower emissions than its previous power solution. The microgrid is also serving as a living lab for the Institute and greater community, further attracting grants and educational opportunities. The net zero carbon levy environment is evolving, such that the carbon offset credits are becoming more and more valuable to the world's largest companies. This investment will not only offset Canada's carbon output, but will also create an opportunity to participate in revenue generation in exchange for carbon stocking offsets as part of your portfolio. So in conclusion, the science behind net zero metrics continue to evolve. And as more creative strategies become tested, more rating tools will become available. Canadian University will benefit from reassessment in coming years once these tools become industry standards tools of measurements. By swapping your current portfolio for one that focuses on net zero objectives, our team achieved your desired risk profile while maintaining a similar industry mix. So we recommend a 60% stock, 35% bond, and 5% alternative investment mix based on our scoring system and shared companies that we identified. Again, we really appreciate the opportunity to share our insight with you and look forward to next steps. Thank you.